The micro-private equity sector, unleashing the potential of small-scale investments. Introduction. Private equity is a powerful force in the global financial landscape, enabling the infusion of capital into various industries. While large-scale private equity firms have long dominated the market, a burgeoning segment called the micro-private equity sector is gaining traction. This essay delves into the world of micro-private equity, exploring its emergence, characteristics, advantages, challenges, and potential impact on the investment landscape. The emergence of micro-private equity. Traditionally, private equity investments have been associated with multimillion-dollar deals, primarily managed by large institutional firms. However, with the advent of technology, globalization, and a shift towards diversified investment strategies, the micro-private equity sector has found its footing. This sector caters to investments of smaller scale, typically ranging from a few thousand to a few $1,000,000. Micro-private equity funds have emerged, attracting investors with smaller budgets and an appetite for higher growth opportunities in niche markets. This segment is built on the principles of entrepreneurship, innovation, and agility, and it emphasizes the value of closely knit partnerships between investors and portfolio companies. Characteristics of micro-private equity. The micro-private equity sector exhibits several key characteristics that set it apart from its larger counterparts. A niche focus. Micro-private equity firms tend to specialize in specific industries or sectors, allowing them to develop expertise and identify promising investment opportunities in underserved markets. B. Hands-on involvement. Compared to larger private equity players, micro-private equity investors are more actively involved in the management and growth of their portfolio companies. They often work closely with entrepreneurs and management teams, offering mentorship, strategic guidance, and operational support. C. Flexibility and speed. Smaller deals allow for greater flexibility and quicker decision-making, making micro-private equity firms more responsive to market changes and investment opportunities. D. Diversification. Micro-private equity funds usually invest in a larger number of companies to spread risk across their portfolio. This diversification strategy mitigates potential losses and enhances the chances of achieving overall success. Advantages of micro-private equity. The rise of micro-private equity brings numerous advantages to various stakeholders in the investment ecosystem. A. Accessibility. Micro-private equity democratizes access to private investments, enabling individual investors, family offices, and smaller institutions to participate in a space traditionally reserved for the wealthy elite. B. Growth opportunities. By focusing on early-stage and growth-oriented companies, micro-private equity funds unlock the potential of small-scale enterprises, contributing to job creation and fostering innovation. C. Alignment of interests. With smaller deals and a hands-on approach, micro-private equity investors align their interests more closely with those of the portfolio companies, facilitating a shared commitment to long-term success. D. Impact investing. Micro-private equity is well positioned to support sustainable and socially responsible investing practices. By investing in local businesses and impactful ventures, these funds contribute positively to the communities they engage with. Challenges in the micro-private equity sector. While the micro-private equity sector holds promise, it also faces certain challenges. A. Limited resources. Micro-private equity firms may lack the substantial resources that larger players possess, which could hinder their ability to provide the same level of operational support and expertise. B. Deal sourcing. Identifying attractive investment opportunities at a smaller scale requires extensive research and a robust network of industry connections, presenting a unique challenge to micro-private equity investors. See exit strategies. Realizing returns on investments can be more challenging for micro-private equity firms due to the relatively smaller size of their investments. Exiting through traditional channels like IPOs or acquisitions might not always be feasible. Deregulatory environment. Micro-private equity funds may face regulatory hurdles, as regulations often cater to larger investment vehicles and may not fully consider the unique characteristics of smaller funds. The potential impact of micro-private equity. As the micro-private equity sector gains momentum, its potential impact on the broader investment landscape is substantial. A market disruption. The rise of micro-private equity could disrupt the traditional private equity model, pushing larger firms to adapt their strategies to accommodate this new breed of investors. B. Economic growth. By channeling capital into promising startups and small businesses, micro-private equity can contribute significantly to economic growth and job creation, particularly in underserved regions. See investment diversity. The proliferation of micro-private equity funds expands the range of investment options available to investors, fostering diversification and reducing dependency on traditional asset classes. D. Inclusive growth. Micro-private equity's emphasis on impact investing and support for local businesses can contribute to a more inclusive and sustainable economic growth model. Conclusion. The micro-private equity sector is an exciting development in the investment landscape, presenting new opportunities for investors and entrepreneurs alike. By catering to smaller-scale investments, this segment democratizes access to private equity and unlocks the growth potential of niche markets. As micro-private equity continues to mature, it is likely to reshape the traditional private equity landscape, influencing how investments are made and fostering a more inclusive and sustainable approach to economic growth. However, to realize its full potential, the sector must address the unique challenges it faces while adhering to best practices and ethical standards that underpin the private equity industry.